You know what's wild? A year ago, my neighbor Steve, solid guy, electrical engineer, makes about 110K a year, finally decided he was ready to buy his first house. He'd been saving for 3 years, had $65,000 sitting in his account, did all the math, got pre-approved, started looking at homes in the 400K range, felt good about it. Last month, I ran into him at the grocery store. He's still renting. Same apartment, same dream. But here's what he told me. Dude, I don't even know what happened. The market just broke. And honestly, he's not wrong. I'm someone who spent the last 15 years studying money, how it moves, where it hides, why it makes people do absolutely irrational things. And what just happened to the housing market over the last 4 years is one of the most bizarre economic events I've witnessed in my lifetime. Not because it was unpredictable, but because almost no one saw it coming, and now almost everyone is confused about where we actually are. So let's talk about it, because if you're trying to buy a house right now, or you own one, or you're just trying to understand why your rent went up 40%, you need to know what actually happened, not the headline version, the real version. Here's the thing. To understand where we are, you have to go back to 2020, March 2020. The world shuts down. The Fed panics, and I mean panics. They drop interest rates to basically zero. They start buying billions of dollars in mortgage-backed securities every single month. The message was clear. We're going to make borrowing money as cheap as humanly possible to keep the economy from imploding. And it worked. Kind of. But here's what most people don't realize. When you make money that cheap, you're not just helping people buy homes, you're changing the entire psychology of the market. Suddenly, a mortgage rate that was 4% a year earlier is now 2.7%. Let's do the math on that for a second, because this is where it gets interesting. If you're buying a $400,000 house with 20% down, so you're borrowing $320,000, at 4%, your monthly payment is about $1,530. At 2.7%, it drops to $1,300. That's $230 a month, almost $2,800 a year. Over a 30-year mortgage, you're saving like $83,000 in interest. That's real money, life-changing money for a lot of people. So what happens? Everyone who was on the fence about buying suddenly rushes in. People who were thinking about upgrading rush in. Investors rush in. And remember, this is still 2020 and 2021. People are working from home. They want more space. They're leaving cities. Demand explodes. But here's the problem. Supply doesn't explode. In fact, supply starts shrinking. Because here's what no one talks about. If you already own a home and you locked in a 2.8% mortgage, why would you ever sell? You're not going to find another deal like that. You're trapped, but in a good way. You're trapped by an incredible interest rate. So inventory collapses. We're talking historic lows. And when you have massive demand and almost no supply, prices do what they always do. They go completely insane. From 2020 to 2022, the median home price in the U.S. went up nearly 40%. 40% in 2 years. Houses that were $300K in 2019 were suddenly $420K, and people were still buying. In fact, people were buying over asking price, waiving inspections, writing love letters to sellers. It was madness. Now, look, at the time, if you were sitting on the sidelines with cash watching this happen, you had two choices: jump in and overpay, or wait and hope it corrects. Most people waited because it felt like a bubble. It looked like a bubble. And if you lived through 2008, you remember what bubbles do. They pop. Except this time something different happened. The Fed looked at inflation hitting 9%, highest in 40 years, and realized they'd made a massive mistake. They'd kept rates too low for too long. So in 2022, they slammed on the brakes hard. They started raising interest rates faster than they had in decades. By the end of 2023, mortgage rates went from under 3% to over 7%. In some cases, over 8%. Let me put that in perspective. That same $320,000 loan we talked about earlier, at 2.7%, your payment was $1,300. At 7%, it now $2,130. That's an extra $830 a month, nearly $10,000 a year, for the same house. And this is where people expected the housing market to crash, because that's what's supposed to happen, right? When borrowing becomes insanely expensive, demand dies, prices fall, the bubble pops. Except it didn't. Here's what actually happened. The people who bought homes in 2020 and 2021 with those rock-bottom rates, they're not selling. They can't or they won't. Because if they sell, they lose that 2.8% mortgage. And if they want to buy another home, they're looking at 7%. That's financial suicide for most people. So inventory stayed low, like really low. We're talking some of the lowest inventory levels in U.S. history. And because supply stayed tight, prices didn't crash. They stopped going up as fast, sure. In some markets, they dropped a little, but there was no 2008-style collapse. And now we're sitting in this bizarre situation where nobody wins. If you're trying to buy a home, you're looking at prices that are still inflated from the 2020-2022 run-up, and you're dealing with 7% interest rates. If you own a home, you're stuck because you can't afford to move without losing your rate. It's gridlock. Most people don't realize this, but we're in what economists call a lock-in effect. It's not a term you hear on the news, but it's the single most important factor in the housing market right now. Homeowners are literally locked into their current homes by their mortgage rates, and that's keeping inventory suppressed, which is keeping prices elevated, which is keeping first-time buyers completely priced out. You might be thinking, okay, but won't this fix itself? Won't rates come back down eventually? Maybe, probably. But here's the thing, even if the Fed cuts rates and we get back to 5% or even 4.5%, that's still way higher than the people who bought in 2021 are paying. So the lock-in effect doesn't fully go away. Those people still don't have much incentive to sell. And let's say rates do drop back to 4%. Great. What happens next? All those people who've been waiting on the sidelines for 3 years suddenly flood back into the market. Demand spikes again. And if inventory is still low, which it probably will be, prices go right back up. It's a trap, a weird, frustrating, historically unusual trap. Now, here's the part that really gets me, the psychological part, because this whole situation has fundamentally changed how people think about housing. A generation of buyers just watched their parents and older siblings lock in 3% mortgages and build massive equity, while they got completely shut out. They saved, they did everything right, and the market left them behind. That creates resentment, but it also creates fear of missing out again. So when rates do eventually drop, whenever that happens, you're going to see a rush of pent-up demand like we've never seen before. And unless we somehow magically increase housing supply overnight, it's going to be chaos all over again. Here's what people need to understand. This isn't 2008. This isn't a subprime mortgage crisis. The people who own homes right now generally have good credit, solid equity, and affordable monthly payments. They're not going to foreclose en masse. There's no ticking time bomb of bad loans about to explode. But that doesn't mean the market is healthy. It's not. It's frozen. And frozen markets don't serve anyone well. They don't serve young families trying to buy their first home. They don't serve people trying to downsize. They don't serve cities trying to attract workers. They just sit there, stuck. So what actually happens next? Honestly, I don't think anyone knows for sure, but here's what I'm watching. 1. Mortgage rates. If they drop below 5.5%, you'll see movement. 2. Inventory. If older homeowners start downsizing or relocating regardless of rate lock-in, that could ease the pressure. And 3. New construction. If builders can actually ramp up supply, and that's a big F, it might create some relief. But in the short term, the next year, maybe 2, we're probably stuck here. Prices aren't crashing, but they're not exactly affordable either. Rates are high, inventory is low, and millions of people are just waiting, hoping something changes. My neighbor Steve, he's still saving, still watching the market. He told me he's accepted that the house he could afford 3 years ago is completely out of reach now. So he's adjusting, looking at smaller places, farther out, different neighborhoods. He's not giving up, but he's frustrated, and I get it. Here's the real lesson in all of this. The housing market isn't rational. It's emotional, it's political, and it's deeply tied to decisions made by central banks that most people don't even pay attention to. The Fed's decision to drop rates to zero in 2020 created a once-in-a-lifetime opportunity for some people, but it also created a once-in-a-lifetime trap for everyone else. And the wildest part? Most people still don't fully understand what happened. They just know housing feels impossible right now. And they're right, it kind of is. So if you're out there trying to figure out your next move, here's my advice. Don't wait for the perfect moment. Don't wait for rates to hit 3% again, because that might not happen for a decade. Don't wait for prices to crash, because they might not. Instead, focus on what you can control: your income, your savings, your credit score, your timeline. The market is going to do what the market is going to do, but your financial position, that's on you. And the people who come out ahead in weird, frozen, unpredictable markets like this aren't the ones waiting for perfect conditions. They're the ones who adapt, who stay disciplined, and who make the best move available to them when the time is right. The housing market didn't break, it just revealed how fragile the whole system really is. And now we all get to live with the consequences.